Nav added RealtyShares in 2013. He left his operating position in late 2017 and exited the board late summer 2018. In today's podcast, he reflects upon the lessons learned from the rise and fall of one of the first, largest, and best respected real estate crowdfunding platforms, RealtyShares. Welcome to the National Real Estate Forum.org podcast, episode 239. Today's conversation is a special edition of the National Real Estate Forum podcast. It's a conversation with Nav Athwal, founder of RealtyShares, as he reflects on his experiences and the lessons learned from having founded the company and, though having left a year beforehand, having watched its untimely demise. In his 1974 book, Winning Through Intimidation, Robert Ringer describes how real estate developers will build apartment buildings in the Sinai Desert, right? Where nobody could possibly want to live if there are investors willing to finance the project. The point that Ringer makes, of course, is that of the tail wagging the dog. Right? That even where there is no substance whatsoever, if an investor is willing to pony up the money, there's always going to be a developer willing to take that money and build the right project in completely the wrong place. It's exactly what is happening in the online real estate syndication world of crowdfunding today. In fact, the next shoe to drop after RealtyShares, if no other platforms fold first, will be when developers start to fail because they're building unrealistic projects in unrealistic places to unrealistic returns, and they're at it because investors are willing to give them the money to do it. Pretty cynical, right? However, I'm extremely confident, so don't get me wrong. RealtyShares recognized this and got that part of the equation absolutely right. They were ultra diligent in ensuring that the projects they put on their platform were thoroughly evaluated. Ironically, a challenge that RealtyShares faced was that the deals that they were getting through their detailed screening process were showing return profiles lower than other crowdfunding platforms because they were consistent with prudent underwriting and they didn't succumb to hyping the real estate assumptions just to drive up returns and to draw in more investor capital. Where the company failed was where real estate developers also fail, right? They sought out and allowed the capital upon which their business model was reliant to dictate how the business was to be built. Through Robert Ringer's lens, they built the right product, an extremely diligent real estate underwriting platform where investors could find credible deals, but they built it in the wrong place, putting it into the high-octane world of tech startups instead of the more sedate real estate world where a steady, long-term perspective is the key to longevity and wealth. Page for today's episode at the National Real Estate Forum website, nreforum.org/RealtyShares special, and sign up for the only news digest focused exclusively on the real estate crowdfunding industry. That's nreforum.org/RealtyShares special. Nav Athwal founded RealtyShares. He's one of America's truly inspirational leaders. He was, in fact, one of the very first entrepreneurs to build a real estate syndication or crowdfunding platform after the Jobs Act was passed. He grew RealtyShares from nothing to being nearly $1 billion company in fewer than 4 years before leaving a year before the company eventually folded. The lessons and insights that he shares with you today provide the backdrop for why, whether you're a developer, investor, or marketplace, or someone else in the ecosystem, that there remains room for considerable confidence and optimism in the new world of online syndicated real estate and optimism in the new world of online syndicated real estate deals through crowdfunding.
So, thanks, Adam, for having me. Pleasure to be chatting with you. I'm sorry it's not at better times, given that RealtyShares recently announced it was laying off the majority of its staff due to an inability to raise capital to continue its business operations. As you know, I founded that company back in 2013. It was my baby. I scaled it from 2 people in a living room to close to $1 billion of capital raised to the platform, $60 million in venture capital raised, 100 employees. and a business model that spanned pretty much every state in the country. We had done deals pretty much in every state. We had investors from every state. We had individual investors. We had started getting institutional investors interested. So the business model, when I left the company a year ago, had a tremendous amount of momentum and I think had a lot of promise. So of it, laying off a majority of the staff was hard for me personally because it was my baby. It was my first venture into tech and in an area of real estate, which I'm very passionate about. So, from my viewpoint, having been the founder and the CEO, but now having been involved in the company's day-to-day for over a year, having left the board 3 months ago to pursue new ventures, it was a little baffling, to be quite honest, because one thing you and I talked about offline is the industry and what the need of this industry is. What the need was back in 2013 and what the continued need of this industry is. And the need is still there. I was on a panel recently and someone asked me, what's going to happen with this industry? Is it going to consolidate? Are there still going to be players that are around, or players going to have the similar fate of RealtyShares? And I said, look, when we started this company, RealtyShares, our thesis, which still remains very true today, even more so, is there's a part of the real estate world that is very underserved by institutions like private equity firms, insurance companies, banks, et cetera. And those are deals that are below $30 to $40 million in total size, where the debt and equity requirements are small enough where it doesn't make sense for a large institution to do the work to fund those deals. And that's exactly the market that RealtyShares and its competitors were going after. It was essentially creating efficiency within the capital markets realm for deals that are below the institutional radar. And 85% of the transaction volume in the U.S. happens within that size of deal. So, majority of the deals happening in the U.S., $500 billion worth of deal volume annually, happen within that middle market sub $50 million deal size. And so, obviously that there's a lot of volume there. There's not a lot of efficiency of capital there. And what models like RealtyShares and what RealtyShares was doing is creating not only more efficiency of capital there, but also creating access to those deals among individual investors and institutional investors. So that need is still there. Commercial real estate is still a massive industry, will still remain a massive industry, and creating efficiency with respect to how investors invest in that market and how operators get capital will remain a need today, tomorrow, 20 years from now, 100 years from now. And as long as commercial real estate is an industry, business models like RealtyShares are needed. Now, with that said, I think RealtyShares, definitely was unable to continue its momentum and was unable to continue scaling its operations. And that kind of takes me to some realizations I came to after leaving the company. I left the company a year ago, and after clearing my head and thinking about what's next, I did have time to reflect on my time there and what I learned about the business model, its weaknesses, its strengths. And so I want to share with your listeners kind of 3 to 4 key learnings that I think are very critical for our competition to keep in mind as they build their businesses, but also for anyone else that's entering the real estate industry from a capital markets lending lens to remember, because I think they can come in handy as they build their own businesses. So I want to kind of start with a key tenet of any startup, and this is something that I used to preach quite often, and maybe didn't do as good of a job as actually sticking to it and building my own company. But the concept of focus. Startups are small enterprises with limited capital, limited resources, and so they need to do one thing really well, and they can't do 10 things really well. And I think one of the things we did at RealtyShares, which in the early days was very beneficial to the company because it gave investors a lot of opportunity to diversify into real estate, but really created a more difficult model for the company, is we funded all kinds of opportunities. We did single family debt, we did commercial equity, we even started a commercial debt business. And in hindsight, those are 3 businesses in one. We had a crowdfunding piece, we had a broker dealer, and that's a lot of complexity for a company that's still in its early stages of development. So as I think about what we could have done better, we probably should have just picked one type of product, one type of financing, and really taken the market on that product before entering new products. And I think if you look at the landscape today, a lot of the companies that started out similar to RealtyShares, originating a lot of different products, have now picked one or two, and that's all they're focused on. There's Lending Home just doing single family bridge loans. There's Fundrise that's, just doing commercial real estate, equity, and debt. One focus area really does help a company scale more efficiently, conserve cash, and build a more singular vision amongst the company and its employees that I think help the company, especially as it hits road bumps along the way. The second thing that I think is critical to remember is these businesses, although they have a technology component, and RealtyShares was building technology and thereby can raise venture capital, which does serve a purpose in the ecosystem, a heavy reliance on outside capital and venture capital, I think, requires you to build a business that you may or may not have intended to build. So capitalists care about is fast growth and a quick exit. Typically, they want to see a deal exit. They want to see a deal, exit typically within, a 5 to 7 year time horizon, hopefully ending in an IPO or a merger with another company. They don't want to see growth rates of 30, 40% a year. They want to see growth rates of 100% plus a year. So, that works for certain types of companies. If you're selling widgets or if you're building a social network of sorts, being able to grow at that rate, there's not a real limit to that other than your own technology and software. But when you're in the business of putting out capital, growth rates that are 2-3x every year can sometimes create the urgency to do deals that you may not otherwise do, or to grow in a way where cracks start forming in the company. So I think as any entrepreneur out there thinks about raising venture capital, it serves a purpose. In the earliest journey, that type of capital is willing to take risks when the company doesn't have revenue or doesn't have sustainable revenue and it's still just an idea and a vision. But as you grow the company and as you think about the type of company you're looking to create, remember to be aligned with your investors and what their vision for your company is. If there's a disconnect there, it oftentimes can create problems that won't surface until the company's, more mature and is hitting some sort of escape velocity and scale. A third key piece of the learning that I kind of realized is when you think about capital. So, our thesis was we want to create efficiency in terms of capital access for middle market deals. When we were early days, having the crowdfunding element of it, the individual investors, was great because we were able to aggregate investors at a time institutions wouldn't talk to us. We didn't have the scale, we didn't have the volume, and so these crowd investors that have a lower threshold in terms of the size of deal they'll fund and the volume they expect were great to be able to fund a lot of our early deals with. But as we scaled the platform and we started funding, instead of $20, $30, $40 million a year, and we started funding hundreds of millions of dollars a year, what we found was our ability to scale was limited more by our capital base than anything else. So if you want to be a capital provider for commercial real estate, whether it's middle market or large cap, the capital piece needs to be relatively efficient, cost effective, and it needs to be there when the operator's deal is closing. So you need to have certainty of capital, you have a cost effective source of capital, and it needs to scale as the business and the deal scale. And I think the crowdfunding element of our business became a limiter. I mean, it required us to have to solve two parts of the two sides of the market at the same time, which made it very difficult at a time when efficiency was key. So, as we developed, as the company matured, we did have access to institutional capital. And what we found is that institutional capital allowed us to not even worry about the capital side and just worry about the deal flow side. So I think a lot of companies that enter this lending space, whether it's commercial real estate, single family, consumer, they realize that as you hit a certain amount of volume and a certain maturity of your company, you're going to institutional capital to be able to scale more efficiently is a key part of the business model. So I do think that businesses that are starting out or that are thinking about what's next need to focus on more efficient sources of capital. And I'm not saying crowdfunding shouldn't be a part of the overall model. I'm just saying if you're looking to build a business that scales and a business that's VC funded where there's growth expectations, relying on the crowd exclusively is going to be very expensive. Relying on the crowd exclusively is going to be very expensive, very cash inefficient, and is going to limit how much volume you can do, and also limit how much of the market you can actually seize. So I think it's a very important part of the business model is thinking through where your capital is coming from for the actual funding of deals and whether that's a scalable source of capital. The last thing I want to say is I think too many businesses out there are focused on, again, especially in the tech space, growing fast, raising venture capital, and not enough of them are thinking about profitability and building a sustainable business model. At the end of the day, if you're starting a business, your purpose in starting that business should be to create a business that can sustain itself without any outside capital, and whether it grows at 500x, 5x growth rate per year, or is just a steady state, that matters less. What matters more is the company and the business sustainable without requiring outside capital, whether that be debt or equity. And too many entrepreneurs, especially in tech, and I think it's the nature of how the tech venture capital markets work, are constantly thinking about raising more money and having that great headline in TechCrunch or the Wall Street Journal and how they just raised $100 million or $50 million, and they're less worried about, are we building the right kind of business here? Do we have positive unit economics? Do we have a path to profitability? And I think the problem with just thinking about the former and not the latter is you oftentimes build a business based on where the venture capital markets are, which are fickle and can change. We saw them change in front of our eyes in 2016 for our specific space. You're not building a business that's where the fundamentals of the business are what's keeping the business around, but rather you're sustaining yourself due to outside capital infusion. So there's businesses out there, that's pivoted their business models from venture capital to asset management businesses. And although their businesses are no longer growing 2, 3, 4x a year and are not going to be funded by venture capitalists now or in the future, what they've been able to do is sustain their business models, get to profitability or near profitability, and completely get rid of the reliance on venture capital as a way to sustain their businesses. So what I'm saying is the crowdfunding industry fundamentally, what I should call is the online syndication industry. The fundamentals are strong. The need is there, but the business model and how it is built and what capital is utilized, that needs to be thought through very intelligently before entrepreneurs, think about venturing on this journey of building online investment and syndication platforms for commercial real estate. So, but anyways, those are the key things that I think I took away from the experience.
Today's episode at the National Real Estate Forum website, nreforum.org/RealtyShares special, and sign up for the only news digest focused exclusively on the real estate crowdfunding industry. That's nreforum.org/RealtyShares special.
Now, and lastly, I'll just say this quickly. When you're building technology, make sure you're building technology for things that add true enterprise value for your customers and for your own business. I think we spend a lot of time building technology for the investor part of our market and not enough time building technology for how we analyze, underwrote, vetted deals, which essentially commercial real estate is inefficient because the way we source, process, underwrite deals is human driven completely. We maybe utilize Argus and Excel models, and we feed in data from CoStar and Reese, but in terms of how we synthesize that data and how we review a deal through an appraisal, that's still very, very, very manual, very inefficient, very costly. And that's why you don't see large institutions funding sub $20, $30 million deals, is because they just don't, think that the cost of underwriting that deal is going to be the same as the cost of underwriting a $70 million deal. But anyways, that's kind of my takeaway from my experience building that company over the last 4 years and being out of it for the last year and change.
Nav, thanks so much for those insights. It's extremely fascinating to hear you reflect upon, especially the last year and the whole experience. You've definitely focused your reflections on, from your perspective as having been the founder of a marketplace. What do you think are the lessons that, and let's talk about both constituencies. Let's start with sponsors and then move on to investors. But what are the lessons investors? But what are the lessons that sponsors can take from, or do you think, would you like to see sponsors taking from the recent collapse of RealtyShares?
Well, I think sponsors, I think the experience and the value we provided sponsors and that others in our space are providing is still very, very strong. As I mentioned, a lot of real estate operators and sponsors that are focused on smaller deals rely on their own network to raise capital. They have to go to 10, 20, 30 investors and syndicate a deal. And the process is manual and offline. There's not a lot of technology enablement there. And they're limited to their network in terms of their ability to fund deals. And I've personally gone through the experience of raising capital for my own deals. And that was kind of one of the reasons why RealtyShares was created, is that process is broken and efficient, very limiting in terms of who these sponsors have access to, and limits the number of deals they can do. I don't think there's a key lesson. I just think that sponsors should continue believing in the model because it is solving a major need. I mean, one of the things we were very proud of at RealtyShares was towards the end of my tenure there, we were able to fund deals where the check size on an equity deal was $3, $4, $5 million, $6 million, whereas when we started, we were barely funding $500,000 per deal. So we were starting to become a major LP for these sponsors and providing them with efficient capital and essentially allowing them to outsource completely their capital raising efforts and focus exclusively on the deal making side, which is what they enjoy, or at least what I enjoy as a sponsor. So I think the only key takeaway for sponsors is continue believing in the model. There's a real value proposition that you can realize as a sponsor by utilizing these models, and there's still a handful of companies out there that are doing what RealtyShares did, and I think they'll be around because they, as I mentioned, have pivoted to models that are a bit more cash efficient and are not just VC capital dependent. So I think sponsors should continue believing in the model because it is solving a real need.
And what about investors that are looking at the news these days and wondering whether or not real estate equity crowdfunding or syndication is a good idea for them?
I would say the same thing on that side. We were solving a real need for investors, individual investors, the doctors, the lawyers, the accountants, the tech entrepreneurs have very limited access to commercial real estate. I mean, they essentially can go buy an asset outright and essentially become a landlord, which is riddled with complexity and is time consuming. They can go buy into a public REIT, which is a lot less diversified from the S&P than a private real estate deal. Also has a higher correlation factor, and it gives them a lot less transparency into some of the assets they're actually getting exposure to. So I think we were solving a real need there. We were providing these individual investors with access to private real estate deals all over the country, not limited by the geography in which they live, an ability to invest smaller amounts, build a portfolio, a diversified portfolio, and get exposure that's not correlated to, other types of investments they may be making, which would include, mutual funds and stock buys and bonds even. So I think that the value proposition is still there. The only thing I would say to investors is, one, what you're investing in when you're investing through one of these platforms is you're not investing in the company. So just because a company stops being a going concern doesn't mean your investment stop or are no longer valid. Those investments are in the underlying deals and in the LLCs that are shielded from the corporate entity like RealtyShares. So you still have an investment that's going to continue to be serviced, because the other piece you have to remember is others like it are not around to service that deal. There's servicing revenue coming from each of those deals that can be, on a $400 million book like what RealtyShares has, can be, $5 million a year. And so there's going to be an incentive for someone to continue servicing that deal, and your investment is not in the company, it's in the underlying deal. So I think too many investors, and I've gotten this question quite a bit since the RealtyShares news came out, is what happens to my investments? And nothing happens to your investments. Your investments are dependent on the performance of the underlying deal and sponsored, not on the performance of RealtyShares. And I think the key thing is having a backup servicer appointed, and that there's revenue within the structure to support that. So I think the only thing I would say to investors is, again, continue believing in the model. It's still solving a real need. Be cognizant of what you're investing in. Only invest what you're comfortable investing into one of these platforms, because at the end of the day, we always were about diversification. Diversify into real estate, put a portion of your portfolio into real estate, not, put every dollar you have into real estate. So I think just like any other investment product, investors need to be thoughtful about diversification and concentration. But otherwise, I would say keep believing in these models. There's plenty of platforms out there that are still doing a great job, and I think there's still a lot of alpha to be generated. And it's the easiest, most simplest way to invest in private real estate.
Thanks so much, Nav. All right, so one final question, I suppose, is what's next for you?
Yeah, so, after leaving the company, I got back into the traditional real estate world through a fund I launched with a partner focused on rebuilding homes in Sonoma County after the Tubbs fire. And it's crazy. It's like deja vu. I'm so saddened by the fires happening, in Paradise and in other areas. Given a year ago, we saw the same thing in the Bay Area in Sonoma County, and we wanted to do something about it. So that's been a really fun experience, and we're starting to build our first few homes now. But to see the new fires at a time when we're just starting to rebuild the fires that happened a year ago is pretty sad. So I'm obviously pained by that, but I want to do my part and try to help rebuild the community that was impacted a year ago. But it feels a little bit like deja vu, unfortunately. But in addition to that, I started working with early stage companies. I mean, one of the things I found I really enjoy is the early building phases of a company, taking a company from, an idea to actually executing that and building a product. And I think that's what really excites me about the early stages of a company. So I started investing in early stage companies and advising a few companies. So altogether, it's probably about 9 companies in my portfolio that are all very early stage that I'm working with. So that's 6 months into kind of what I call my rewirement. I started reflecting on some of the lessons I just shared with you. And as a result, I'm starting I started a new venture in commercial real estate tech. It's stealth right now, so I can't say much about it, but I'd love to come back, in a month or a month's time and share more about it when we're a bit more public. But it's essentially applying all the learnings from RealtyShares in a new model, a much more focused model, with 2 terrific co-founders that I worked closely with at RealtyShares, and doing something that I think could be pretty game-changing for the industry in terms of how it operates and some of the inefficiency that surrounds it. So, yeah, I would love to come back and share that with you at a later date. But at the moment, it's stealth, and I'm very excited about this new chapter.
Fantastic. Yes, I'm extremely inspired by your ability to get back up and get back on the horse. Right? It's inspiring.
Well, you got to. I mean,
your ability to get back up and get back on the horse. Right? It's
well, you got to. I mean, I think what you learn from what you learn from a failure is 5x more valuable than what you learn from a success, because a lot of things have to go wrong, and you learn a lot when things go wrong. So I think, albeit it's not the ultimate ending I wanted for RealtyShares when I left a year ago, and we had 20-something million in the bank, I thought we were going to build the leading platform, and we were a leader in our space. And to see where it is now is obviously saddens me and is not the ultimate outcome I wanted. But you also can't continue dwelling on the past. You have to kind of look forward to see what you learned and how you can apply that to your next adventure or venture. And that's what I'm trying to do.
Fabulous. Well, I'm really looking forward to discovering what that new chapter is, Nav, and we'll definitely talk about it. We'll do a podcast when the time comes.
Absolutely. That'd be great, Adam.
I am passionate about this industry. I've built a bunch of online courses so that investors can find and evaluate good deals online, and I assist developers in getting online to raise capital so that they can build their investor base. If you're interested in finding out more about either of these, go ahead and email me at adam@nreforum.org and I'll send you more information. Nav is moving on to bigger and better things and is carrying with him the lessons learned from the extraordinary experience founding and running RealtyShares. Be sure to subscribe to this podcast series at the National Real Estate Forum at nreforum.org, where I've included links to most of the major subscription platforms, iTunes and the like, about halfway down the homepage. Thanks for listening in, and thanks, Nav, for spending your time with me today. Looking at the inside of RealtyShares, as we've had the privilege to do this last 3 podcasts, it's clear, Nav, that you built an extraordinarily professional company. And I'm disappointed in seeing it fail as I know you are, of course, but looking forward very much indeed to hearing what you get up to and to speaking to you again. Until next time, this is Dr. Adam Gower signing off.